Welcome back to Avon Pension Fund Investment Panel. Apologies for my confusion earlier. We've just discussed exempt Appendix 3. We're now on to Appendix 4 and Appendix 5. Are there any questions and comments before we move on to Mercer's presentation on Appendix 5?
No.
So I believe Steve Mercer, you're going to introduce Appendix Item 5.
Yeah, thank you, Chair. Yeah, so in the paper entitled Metamorphosis, it's a sort of summary of Mercer's key themes and opportunities, which we produce at the sort of start of each year. It's in the pack mainly for information and reading. There's always lots of things going on in investment markets. We thought it would be sort of useful information to bring out the three key themes in that paper and how it relates to the fund and how you're positioned and future plans. There's the first area is in relation to what we refer to as like changing of the guard, and this very much relates to the shift away from quantitative easing, perhaps use of reduction in central bank supports, a rising inflationary environment, and the impact that rising interest rates could have. Overall, your portfolio does not have a lot of risk exposure to rising rates, and we do think it can have some return opportunities, and that would most directly relate to the additional allocations being made to private debt, as previously mentioned. The next theme is in relation to being positioned for the climate change transition. We don't think there's anything new that you need to do in relation to that. Clearly, it's a massive theme for investors currently, but you've been well ahead of that for a number of years now. And later on this year, we're going to be doing some additional analysis, looking at the Brunel portfolios and looking at how well positioned they are from a transition capacity perspective. So that's going to be an important area of work in the latter half of the year, probably. And then the final theme is about modern diversification. And I think the best way to talk about this is because of low bond yields and the risk of bond yields rising, the traditional role of fixed income is going to be very challenged in that they're unlikely to provide the level of protection and downside protection usually expected versus when other growth assets fall in value. So we're very much encouraging investors to look at alternative ways of diversification and protection. You've already got that with the dynamic equity protection. So we actually think you've been positioned well ahead of this paper in terms of our key views for the next year or so. And there might be some other ideas that you're interested in, but we didn't think there are actually any new themes and opportunities that you seriously needed to look at. So, overall, notwithstanding all the uncertainty in the world, but thinking about, what your core objective is, looking to achieve that return that you need to support pensions in a climate aligned way, we do think you're well positioned. Happy to take any questions.
Steve. Thank you.
I think Shirley wants to ask a question. I don't know whether Sean's frozen again.
Yeah, if that's okay. And Steve, it's just a question about reporting, and it might be something that you said you're looking at when you're looking at the Brunel portfolios in the future.
Yeah.
But I know obviously we're invested in some very overt renewable and transition assets. When it's clear to say that's a climate change positive or renewable, but we are also invested in other things that are in more general portfolios that are also making a positive contribution. So how do we, or can we, make sure that we're capturing that as part of our reporting in terms of what we are doing?
Yeah, so the obvious area there where we'll be sort of looking at that is part, or when you're doing work for TCFD reporting.
Yeah.
So we'll do the sort of the annual update of the carbon metrics that we discussed last year, and a lot of that was based on the equities. That's where the data is most readily available. But the intention is, working with Brunel, that every year we look to expand coverage where available and where the data is sensible.
Yeah. So that will. I know it's an evolving picture, isn't it?
Yeah, I mean, I think it's unlikely that we'll see like very quick progress in terms of getting accurate data, say in private markets, but there's a lot of developments and a lot of initiatives going on, especially in property, which Brunel did mention earlier. So we'd expect improving data there. We're certainly seeing developments with some multi-asset credit managers, and we know Brunel have selected multi-asset credit managers that are very, very strong, particularly on net zero targets. So we're hopeful, certainly for multi-asset credit, that we'll be able to include more meaningful data the next part of the TCFD review.
Yeah, and I know the data is important, and particularly around the net zero. But if we're making, if the assets we're investing in or lending to are making a positive contribution towards the transition, then that's important as well, isn't it? So it's a more general feel for it as well, rather than just the actual pure stats. Yeah. Okay. Yeah. Thank you.
And just to follow on from that, I mean, Brunel are doing a lot of work on it, but they are, one of the things is that the consistency of the data. So if they say, what if they're not necessarily getting data that's consistent, so it's not necessarily given a good or a meaningful impression of what's happening or what we're exposed to. So there's that, and it is very much, I mean, I think property is the next area in MAC, that the two areas that are real doables on the doable list. But I think some of the other areas will remain quite difficult for a while. But and the other thing is it takes resources and money to fund that sort of service and everything. And that's something that we do need to make sure that Brunel do have the resources to do that if we expect them to be able to deliver it. So, that's an ongoing conversation as well. But it's definitely on the agenda. But it's one of the things they are promoting in terms of their engagement with policy makers and industry initiatives and everything, because they just think it's really important. But that's the way that they're trying to drive the agenda.
Yeah. No, that's helpful. Thank you.
Have I frozen?
Oh, you're back. That's fine.
Yeah, I'm back. Sorry, my internet is not playing ball today, so apologies for that, especially those members of the public watching.
We've lost you again, Sean.
I have a question.
Oh, sorry, carry on.
Sorry.
Carry on, yeah.
The questions around the Asian century and China and that, and obviously we've withdrawn from the emerging markets at the moment, but obviously we keep that under active review for the future. And if we were
Sorry, Sean, I didn't quite catch that.
Differential. Sorry, everyone's. So my question, you talked about the Asian century, and we have come out of the emerging markets as a strategic decision at the moment, although we're keeping that under active reviews, which are excluding China and focusing on Southeast Asian countries in its investment. At first,
yes.
I caught some of that, but not a lot.
Sean, do you want to try if you can hear me using without your camera feed on? Sometimes that helps.
but
I can maybe say a few words, Sean. I think I got the gist of the question. So let me know if what I'm about to say doesn't address your question. But so I was expecting a question actually about this Asian century. And the first thing I'd say is that not all the themes and opportunities will be relevant to all clients. And I think whilst there are some undoubtedly strong arguments to be positive on China and Asia from a long-term return perspective, I think investors that want to have net zero targets, investing in China does present some particular challenges, and emerging markets in general. And so we discussed that in great details last year. And as you'll remember, we were able to demonstrate that you could come out of emerging markets, have an improvement on your climate metrics, be well positioned to achieve your net zero targets next year over the coming years without compromising the expected return. And we're trying to get that balance between having confidence in getting your expected return, but also helping you do the net zero transition. I think it is generally accepted that China and emerging markets are particularly carbon heavy sectors, and the world will need companies and governments in those areas to decarbonize. So they are part of the solution. But it was felt that it was a sector that you weren't particularly comfortable investing in. You prefer to invest in more dedicated, sustainable equity options, because coming out of emerging markets has allowed you to invest further in sustainable equities. It allows you to have stronger engagement because of the greater weight of capital in developed market equities as well. But if the situation improves with emerging markets and China, we're totally open-minded to potentially revisiting that decision in the future.
Thank you. I've just switched to my iPad, so hopefully that will be a bit more stable than my desktop. For some reason, it tends to be. It was really about, if we did make that decision, what would be the advantages or disadvantages of having a re-engagement with emerging markets, either across all of them or excluding China for geopolitical reasons, and keeping with India and the Southeast Asian organization countries. Yeah.
So if we can get very targeted exposure in a way that's easy implementable, say in theory with Brunel, we'd have to be judging that based on, is it additive to return? Is it going to help enhance return? Is it going to be add genuine diversification? And is it consistent with your overall climate goals? They would be the 3 or 4 key areas that we're assessing any investment decision on.
Thank you very much, Steve. Thank you. Does anyone else have any questions on Appendix 5, the presentation from Mercer's and Steve? No, I'm not seeing anything in the chat. So therefore, we just need to ask someone to move the recommendations that we note the papers and the report on the review of our investments performance for the period ending the 31st December 2021. Can I see someone to move that, please?
Happy to propose, Sean. Oh, sorry.
Thank you. I saw John Finch first and Councillor Dando to second that. And I will assume that everyone is in favour of noting the various appendices and the discussions that we had today. Thank you. So now we move on to item 10 on the agenda, which is the risk management framework review for the period ending the 31st December 2022. And I invite Nathan to introduce this paper.
Thank you. Another paper for noting. The main item at FRMG's last meeting was the inflation hedge ratio. And Mercer will take you through a summary of that discussion. And maybe, Nick, you could also comment when we move into exempt on the costs attached to adjusting the EPS and taking out that emerging market portion.
Yeah, thank you. So I haven't got the papers up in front of me now because I'm on my iPad and I'm just trying to get them up. So is there anything we need to say in public session before we move into private session? Nope.
No.
No. So therefore, the panel, having been satisfied that the public interest would be better served by not disclosing relevant information, proposes, in accordance with the provisions of the section 100A4 of the Local Government Act 1972, that the public should be excluded from the meeting for this item of business because of the likely disclosure of exempt information as defined in paragraph 3 of part 1 of Schedule 12A of the Act as amended. And I assume everyone's in favour of that. Therefore, we will move into private session and we'll say goodbye to members of the public for now, and you'll be able to join us back again in a few minutes' time. Thank you.